Imagine waking up one morning to find that a single investment decision you made years ago has completely transformed your financial future. That's not just a dream. That's exactly what happened to thousands of investors who bought Nvidia back in 2005 when the Motley Fool recommended it. A mere $1,000 investment would be worth over $1.1 million today. But here's the thing. You don't need a time machine to find incredible investment opportunities. You just need to know where to look in 2026. Right now, we're living through one of the most exciting times in market history. Artificial intelligence is revolutionizing entire industries. Energy markets are undergoing massive transformations. Healthcare innovations are extending human lifespans. And the companies leading these changes are offering investors unprecedented opportunities to build serious wealth. But with thousands of stocks to choose from, how do you separate the winners from the losers? How do you find the stocks that won't just survive, but absolutely thrive in 2026 and beyond? Today, I'm going to reveal the top 5 stocks that experts believe have the potential to deliver exceptional returns in 2026. These aren't just random picks. These are companies backed by real data, proven track records, and compelling growth stories. Some offer generous dividend income that can pad your wallet every single quarter. Others are positioned to ride massive industry tailwinds that could multiply your investment several times over. And the best part? You don't need to be a Wall Street insider or have millions of dollars to get started. Let's dive in. Before we get into the specific stocks, let me explain the strategy behind these picks. We're looking at 2 types of investments here. First, we have dividend powerhouses. These are established, profitable companies that pay you cash regularly just for owning their stock. Think of them as the tortoise in the race, slow and steady, but they cross the finish line with money in your pocket. Second, we have growth dynamos. These are companies expanding rapidly, reinvesting their profits to capture larger market share and build dominant positions in emerging industries. They're the hare, moving fast and aiming for explosive returns. The smartest investors don't choose between these 2 categories. They build portfolios that include both, creating a balanced approach that generates income today while positioning for significant capital appreciation tomorrow. So let's explore the 5 stocks that could supercharge your portfolio in 2026, starting with a company that's been paying dividends longer than most of us have been alive. First up, we have Chevron, trading under ticker symbol CVX. Now I know what you're thinking. Oil companies? Really? Aren't we supposed to be moving away from fossil fuels? Well, here's the reality that many investors miss. While the world is absolutely transitioning to renewable energy, that transition is going to take decades, not years. And during that time, oil and natural gas remain absolutely critical to keeping the global economy running. That's where Chevron comes in. Chevron currently pays a quarterly dividend of 1.78 per share, which works out to an annual yield of around 4%. But here's what makes this truly impressive. Chevron has increased its dividend for 39 consecutive years. Let me repeat that. 39 years in a row. That means through recessions, oil price crashes, global pandemics, and every market downturn imaginable, Chevron has consistently rewarded its shareholders with growing dividend payments. That's not luck. That's a business model that works. But Chevron isn't just about the dividend. The company just closed its acquisition of Hess, which is expected to fuel over 10% compound annual free cash flow growth through 2030. What does that mean for you as an investor? It means more money flowing into the company's coffers, which translates to more dividend increases and potential stock price appreciation. Chevron also has one of the strongest balance sheets in the energy sector, with a debt-to-equity ratio of just 0.22. This gives the company enormous flexibility to weather storms and capitalize on opportunities. Just recently, Chevron's stock hit a 3-year high, fueled by solid quarterly results and geopolitical developments, and analysts remain bullish, with many predicting continued strong performance throughout 2026. For investors seeking reliable income combined with potential upside, Chevron represents a compelling opportunity. Now let's shift gears completely and talk about our second stock, Verizon Communications, ticker VZ. If Chevron is the steady income play, Verizon is the ultra-high yield champion. We're talking about a dividend yield of 6.8%. To put that in perspective, if you invested $10,000 in Verizon today, you'd be collecting $680 in dividend income every single year. And Verizon has increased its dividend for 20 consecutive years. But here's what makes Verizon particularly interesting right now. The telecommunications giant produces massive amounts of recurring cash flow. Think about it. Every month, millions of Americans and businesses pay their wireless and internet bills. That creates an incredibly stable, predictable revenue stream. Through the first 3 quarters of 2025, Verizon generated over $7 billion in excess free cash flow after funding all its capital expenses and dividend payments. That's real money in the bank. Now, I need to be completely transparent with you here. Verizon isn't a fast growth company. The telecom industry is mature and competitive. Verizon operates in a capital-intensive business and carries significant debt. The company recently brought in a new CEO tasked with boosting growth, which could potentially lead to strategic changes. Some analysts suggest watching to see what direction the new leadership takes before jumping in. However, for investors specifically seeking high, reliable income with relatively low volatility, Verizon's 6.8% yield is extremely attractive, especially when compared to the S&P 500's measly 1.1% average yield. Our third stock takes us into the world of consumer goods with PepsiCo, ticker PEP. Now you might think, Pepsi? That's boring. I want exciting tech stocks. But hear me out. PepsiCo isn't just about soft drinks anymore. This is a massive, diversified global powerhouse with brands like Frito-Lay, Quaker, Gatorade, Tropicana, and yes, Pepsi. The company operates across 7 global segments and touches billions of consumers every single day. What makes PepsiCo particularly compelling for 2026 is its combination of stability and growth. The company has pricing power, meaning when costs go up, PepsiCo can raise prices without losing significant market share because their brands are so strong. This is crucial in an inflationary environment. PepsiCo also pays a solid dividend with a long history of increases, making it attractive for income investors. But unlike pure dividend plays, PepsiCo continues to grow. The company is expanding in emerging markets, innovating with healthier product lines, and leveraging its distribution network to capture more market share. Several top investment analysts have PepsiCo on their top dividend stock lists for 2026, citing its competitive positioning, attractive valuation, and strong dividend growth record. For investors who want a blue-chip stock that combines stability, income, and moderate growth potential, PepsiCo checks all the boxes. Now we're going to shift into hyperdrive and talk about growth stocks, starting with number 4, NVIDIA, ticker NVDA. If you've been anywhere near the stock market in the past few years, you've heard about NVIDIA. This company has delivered absolutely mind-blowing returns, rising over 1,100% in just 5 years. But here's the question everyone's asking. Is it too late to buy NVIDIA? According to top analysts, absolutely not. Despite periodic volatility, NVIDIA remains exceptionally well-positioned to benefit from long-term demand for artificial intelligence infrastructure, data centers, and accelerated computing. The company's revenue is projected to grow roughly 60% in fiscal 2026 and another 50% in fiscal 2027. Let that sink in. We're talking about a company that's already huge, still growing at rates that would make most startups jealous. NVIDIA's dominance in AI chips is almost unprecedented. When companies like Microsoft, Google, Amazon, and Meta build their AI systems, they're buying NVIDIA's chips. When startups develop the next generation of AI applications, they're running on NVIDIA hardware. This isn't a fad, this is the foundation of the next industrial revolution. Analysts at Bank of America recently stated that artificial intelligence remains the place to be in 2026, and NVIDIA sits at the absolute center of this transformation. In the third quarter alone, NVIDIA's revenue grew 62% year-over-year, while net income surged 65%. These aren't small numbers for a company of NVIDIA's size. Analyst Angelo Zeno projects that edge device penetration, an expanding total addressable market, And opportunities in software will create even more growth avenues for NVIDIA in coming years. For investors with a higher risk tolerance and a long-term time horizon, NVIDIA represents one of the most exciting growth opportunities available. Our fifth and final stock is Micron Technology, ticker MU. Now, Micron might not be a household name like NVIDIA, but it's absolutely critical to the AI revolution. While NVIDIA makes the processors that power AI, Micron makes the memory chips that store and access the data those processors need. Without Micron's high-bandwidth memory chips, AI systems simply wouldn't work. And the results speak for themselves. Micron stock has surged over 250% in the past year, but here's the kicker. Despite this massive run-up, the stock is trading at a forward price-to-earnings ratio of just 9.7 times, compared to the semiconductor sector average of 24 times. That means Micron is trading at a 60% discount to its sector. On a PEG ratio basis, which combines valuation with growth, Micron scores an A+ rating, trading at an incredible 87% discount to the sector average. In other words, even after the stock has more than tripled, it's still cheap relative to its growth prospects. Micron reported fourth quarter revenue of $6.5 billion in its semiconductor segment, up 74% year over year. The company's AI semiconductor business now makes up more than a third of total revenue, and management expects this segment to see 100% revenue growth in the first quarter of 2026. That's a doubling of revenue in just 3 months for this segment. Stephen Kress, head of quantitative strategy at Seeking Alpha, named Micron Technology as his #1 stock pick for 2026, highlighting its sector-leading growth, profitability, and compelling valuation. For investors who believe in the AI revolution but want exposure at a more reasonable valuation than some of the mega-cap tech names, Micron presents a fascinating opportunity. So there you have it. 5 stocks, each offering something different. Chevron provides energy sector exposure with a growing dividend and strong fundamentals. Verizon delivers ultra-high income for those seeking maximum cash flow. PepsiCo combines stability, brand power, and consistent dividend growth. NVIDIA offers pure AI growth with market-leading technology, and Micron provides AI exposure at a surprisingly attractive valuation. But here's the critical question. How do you actually invest in these stocks? Let me give you some practical advice. First, don't try to time the market. You're not going to buy at the absolute bottom or sell at the absolute top. Nobody does. Instead, consider dollar-cost averaging, where you invest a fixed amount regularly over time. This approach reduces the risk of investing everything right before a market downturn. Second, understand your own risk tolerance and investment timeline. If you're 25 years old and won't need this money for 40 years, you can afford to be more aggressive with growth stocks like NVIDIA and Micron. If you're 60 and planning to retire soon, you might want to emphasize the dividend payers like Chevron and Verizon. There's no one-size-fits-all approach. The best portfolio is the one that lets you sleep at night while still pursuing your financial goals. Third, diversification matters. While I've highlighted 5 excellent stocks, putting all your eggs in these 5 baskets still concentrates your risk. Consider these as core positions within a broader portfolio that might also include index funds, international stocks, bonds, or other asset classes. The goal is to build a resilient portfolio that can weather whatever 2026 throws at us. Fourth, do your own research. Everything I've shared today is based on expert analysis and current market data, but markets change. Companies evolve. New information emerges. Before you invest a single dollar, read the company's annual reports. Understand their business models. Know what could go right and what could go wrong. Informed investors make better decisions. Let me share a real-world example to drive this home. Imagine an investor named Jennifer, who started investing in 2020. She put $5,000 into NVIDIA when it was trading around $120 per share. She felt nervous when it dropped to $108 a few months later during the pandemic crash. But she held on. Today, that investment would be worth over $80,000. That's more than a 1,500% return in less than 6 years. But here's the thing. Jennifer also invested $5,000 in a dividend-paying stock like Chevron at the same time. While Chevron didn't give her those explosive returns, it paid her steady dividends even during the worst of the pandemic. Those dividends gave her cash flow when she needed it and helped balance the volatility of her growth positions. That's the power of a balanced approach. The growth stocks in your portfolio work on building your wealth over time. The dividend stocks provide income and stability along the way. Together, they create a portfolio greater than the sum of its parts. Now, are these 5 stocks guaranteed to make you rich? Of course not. Investing always involves risk. Chevron's profits depend on oil prices, which are notoriously unpredictable. Verizon faces intense competition and technological disruption. PepsiCo must navigate changing consumer preferences and input cost inflation. Nvidia's valuation depends on continued AI adoption, which could slow down. Micron operates in a cyclical industry where demand can swing dramatically. But here's what we do know. Each of these companies has demonstrated resilience, innovation, and the ability to generate value for shareholders over extended periods. Each addresses fundamental human needs: energy, communication, food and beverage, and technology. Each has strong competitive positions in their respective markets, and each offers investors a clear investment thesis backed by solid fundamentals. As we move through 2026, the market will undoubtedly face challenges. There will be days when your portfolio is down. There will be headlines that make you nervous. There will be moments of doubt. That's all part of investing. But if you've built a thoughtful portfolio based on quality companies with strong fundamentals, growing earnings, and clear competitive advantages, you're positioning yourself for long-term success. Remember, the best time to invest was yesterday. The second best time is today. While you can't change the past, you absolutely can shape your financial future. The companies I've highlighted today represent some of the most compelling opportunities available to investors right now. Whether you choose one, all 5, or use these as a starting point for your own research, the important thing is to take action. Don't let fear of making the wrong choice paralyze you into making no choice at all. Start small if you need to. Learn as you go. Adjust your strategy as your knowledge and circumstances evolve. But most importantly, get started. Because while nobody can predict exactly what 2026 will bring, we can be absolutely certain of one thing. The investors who participate in the market will have opportunities that those sitting on the sidelines will miss entirely. So do your research, make your plan, take that first step. Your future self will thank you.